Will your money survive if stocks crash in 2024? Lots of experts think markets could get bumpy next year. Some say a big drop might happen. What can you do to stay safe? How do you lock in gains before things go downhill? Welcome back to Digital Financial Freedom. Let's talk simple tips to prepare your dollars for the next downturn. Getting defensive today sets you up to still earn tomorrow. This crash course covers all you need to know. Watch the video to learn key strategies even new investors can use if 2024 turns ugly for Wall Street. The time to shield your hard-earned cash is now. What the experts are saying. Most experts agree that the likelihood of a recession in 2024 is low given certain positive economic indicators like a resilient housing market and expected interest rate cuts from the Federal Reserve. However, the effects of the Fed's aggressive interest rate hikes in 2022 will still reverberate through the economy next year, likely resulting in slower growth at times. Invesco's Christina Hooper foresees a bumpy landing in 2024, marked by ongoing inflation putting pressure on consumer budgets, more small business bankruptcies due to tight financing conditions, a small uptick in unemployment as rate hikes impact business activity. However, she believes any economic pullback will be temporary. Hooper expects growth to rebound in the second half of 2024 once inflation cools and the Fed starts cutting interest rates. Similarly, Jay Hatfield of Infrastructure Capital Advisors believes 2024 will usher in a new era of global rate cuts, providing a bullish tailwind for stocks. With the economy still expanding and AI adoption accelerating, Hatfield sees little chance of recession barring an unexpected shock. Both experts advise investors to remain invested in stocks while rebalancing portfolios to weather near-term volatility. Defensive sectors like real estate and utilities may offer stability during market swings. Bonds and dividend stocks can also offset risks as rates decline, staying balanced in a bumpy market. Even the most optimistic outlooks predict some economic turbulence in 2024. How should investors prepare for potential volatility while still capitalizing on growth opportunities? Amid conflicting economic signals, portfolio diversification will be key to balance risk and reward. Ensuring you have exposure to bonds, dividend stocks, high-quality large caps, small caps, international assets, and alternative investments can smooth out returns while avoiding overexposure to any single asset class. Within stocks, focusing on companies with strong fundamentals can provide another layer of defense. Seek out firms with growing free cash flow and dividends, reasonable valuations, high returns on invested capital, strong balance sheets, pricing power amid inflation. Sectors like healthcare, utilities, and consumer staples tend to hold up better during times of market stress. However, maintaining some growth exposure in areas like tech and communications allows benefiting from rising markets. It's also wise to keep some dry powder handy in cash and short-term bonds. Having funds available to deploy into market pullbacks lets you buy stocks when they go on sale. Dollar cost averaging into new positions gradually is another prudent strategy, playing offense and defense in your portfolio. While balancing safety and growth, here are some specific portfolio moves to consider. Play defense. Add exposure to defensive sectors such as healthcare, utilities, staples, and telecom. Emphasize large cap stocks with strong balance sheets and dividends. Buy short-term bond funds to park cash until market stabilizes. Hold 6 to 12 months living expenses in cash reserves. Only buy top quality bonds with high credit ratings. Play offense. Increase international stock exposure, especially emerging markets. Deploy cash into stock sectors hit hardest in 2022 sell-off. Develop covered call strategy to boost yields. Scale into small cap value stocks over several months. Add floating rate bank loan funds if inflation persists. Diversification is critical, but so is staying nimble to capitalize on market swings. Blend proactive offense with thoughtful defense based on your personal risk tolerance. Bond investing in a rising rate environment. After falling sharply in 2022, bond yields may have bottomed given expert predictions of Fed rate cuts commencing in 2024. However, fixed income investing still warrants caution until inflation shows more concrete signs of slowing. Where should bond investors focus today? As with stocks, quality and diversification are paramount in bonds. Emphasize securities with higher credit ratings. Consider actively managed bond funds versus passive ETFs. Shorten duration to limit rate risk. Build multi-sector bond exposure, including corporates, munis, mortgages, treasuries, and TIPS. Add floating rate bank loans and short-term bond funds. Also utilize CD ladders to capture higher yields. And leverage bonds for income rather than capital appreciation. Target coupon payments over 4 to 5% and hold bonds to maturity rather than worry about price fluctuations. Advanced strategies like unconstrained bond funds and long-short credit funds can provide enhanced diversification as well. Just be wary of reaching for yield without appropriate due diligence. Income-seeking investors can boost cash flow via preferred shares, MLPs, REITs, and dividend equity funds. But these should be limited to a portion of your overall portfolio suitable to your risk appetite. Bonds still offer viability in a portfolio, but require an active management approach in the current environment. As the Fed's policy path clears, high-quality fixed income will regain appeal to offset equity risk. Actionable investing strategies for 2024 and beyond. As global markets progress through the current monetary policy cycle, creating some guardrails around your portfolio can help navigate uncertainty while avoiding emotional decision-making. Here are 5 investing principles to follow, regardless of economic conditions. Confirm your target asset allocation aligns with your time horizon and risk tolerance. Maintain discipline around these targets before making significant allocation changes. Focus on quality across asset classes. For stocks, emphasize profitable companies with solid leadership and durable competitive advantages. In bonds, steer towards issuers with higher credit ratings and cash flows to service debts. Diversify broadly across sectors, market caps, geographies, styles, and asset classes. Blend interest rate-sensitive assets with inflation hedges and hybrid securities. Mitigate concentration risk. Dollar cost average on a fixed schedule into well-chosen ETFs and mutual funds. This forces investing discipline, takes emotions out of decisions, and smooths entry points. Rebalance at least annually back to target allocations. This compels you to trim appreciated assets and buy into cheaper ones routinely rather than relying on market timing. Blend these principles with sensible risk-taking, and your portfolio should successfully traverse various market environments. Of course, the keys to long-term investing haven't changed. Start early, spend less, minimize taxes and costs, diversify intelligently, and stay the course. Easier said than done, but separating emotions from evidence-based decisions wins out over time. As legendary investor Shelby Davis once remarked, "You make most of your money in a bear market, you just don't realize it at the time." Experts see risk ahead in 2024, but no one truly knows what will happen. Stocks may swing up or down, so preparing today is vital. Have a game plan to both play offense and defense. Keep investing for growth, but also protect existing dollars. Balance is key. Blend safe and risky areas. Divide money across stocks, bonds, cash. Trim winners by low too. Stay disciplined no matter what. Control fear, stick to financial targets. Tuning out hype stops rash moves. Avoiding panic equals long-term gains. Market drops aren't fun, but overreacting hurts most. Steady investing weathers storms. Knowing yourself and diversifying wisely lessens crash impacts. The future is uncertain. Being ready for anything offers peace of mind. The countdown to 2024 is on. What proactive moves will you make this week to fortify your portfolio against market turmoil in the year ahead? Let me know in the comments section, and that's a wrap. If you like this video, be sure to like and subscribe to Digital Financial Freedom for more videos helping you take control of your money and invest with confidence. 2023 promises its fair share of ups and downs,